All right, welcome back to the Earnings Corner on Trades and Gains. I'm your host, Max Pitts, and make sure you are subscribed, like, and comment on this video with your favorite earnings play of the week. Again, this video is, as always, powered by Investor Central Club, where you can use the code SUPERMAX20 to get 20% off your first month. So, today, we got SMCI to talk about. We're currently live doing these on Twitch as well over at Free Wi-Fi Radio. So come ask your questions, get the live breakdown and more, all right? And SMCI is the company that's basically the Costco of AI servers. Everyone wants to believe it's a straight line AI play. AI demand is up, servers are shipping out, stock goes up, and everyone gets a happy ending like they went to Good Time Happy America Coca-Cola massage parlor, right? But Wall Street is starting to ask a really annoying question. If AI is booming, why are earnings and margins doing the opposite? And that's what makes this quarter spicy, like that habanero pepper that girls put in their dating profiles to let you know what they do for a living. SMCI reports Q2 fiscal year 2026 guidance or results on Tuesday, February 3rd after the close, and the earnings call is expected at 5 p.m. Company guidance for the quarter: revenue is expected between $10 and $11 billion. EPS is expected at 0.46 to 0.54, non-GAAP included. Consensus is basically parked near midpoint, which revenue is 10.2 to 10.4 billion, and EPS is 48 cents to 49 cents. So far, nothing crazy until, well, we look at the trend, right? Here's the real headline. Revenue, it is currently expected to be enormous. 84% year over year per some previews. However, EPS is expected to be down 19 to 24% year over year, and their EBIT forecast is down 0.42, so 420 million, which is down 13% year over year. So the setup is AI server demand. Is it exploding? Yes, no one can deny that, but profitability is shrinking, and that's not good or bad. It's just what the numbers and the math here imply. Okay? This quarter is literally scale versus spread. Scale equals, well, can you ship at AI rack volume? And spread is, do you keep enough margin to make it worth it? Now, let's talk about why this quarter matters beyond the numbers. Last quarter, for Q1, revenue came in at $5 billion, consensus was closer to $6.4 billion, and that's a miss of $1.4 billion on revenue. They still beat EPS at 35 cents versus 31 cents, but EPS was down from 67 cents a year ago. So investors aren't just watching growth, they're watching execution credibility. Because after a miss like that, this quarter becomes, can you actually hit your own guidance band? So the street expects a sharp sequential rebound. 5 billion last quarter, 10 billion this quarter. Why? Because business is concentrated in AI accelerated, GPU dense rack scale systems tied to NVIDIA architecture and the 2026 ramp cycle, including Blackwell. So don't worry, the demand is very much real in there, but investors aren't debating demand anymore. They're debating who captures the profit. Now here's what the cautious notes keep pointing to. Margin pressure can come from integration plus engineering costs on huge deployments, logistics plus throughput costs during rapid ramps, and mix shifting to more passing through components in rack scale systems. Let's break that down in English. SMCI can ship more, but it's mostly passed through hardware, and ramp costs for that are heavy. So what does that do? Eat into their margins. Exactly. Good one, class. So the company becomes big revenue, small earnings, and lots of trust us, it'll normalize in the long run. It's like, trust me, bro. No, I'm not going to. That's why some analysts ask about margin volatility, even with strong demand. Because if you're just shipping other people's stuff, that's eating into your margins, right? Like, am I making sense here? Now, here's the most controversial fact. Management targets, well, 36 billion in net sales by FY26. Yet consensus full year for full year 26 EPS is around $1.70, slightly down from full year 25, which was $1.72. And the big EPS step up is modeled more in full year 2027. So here's the real stir the pot question. If revenue is going to the moon, why isn't EPS? Again, no opinion. That's what the consensus path implies. So here's the predictions. 1, they hit the scale, protect the spread. Revenues above 10.4 billion, EPS above 49 cents. Gross margins are stable / better than feared, and commentary frames last quarter miss as timing, not structural. Number 2, revenue's okay, margins disappoint. Revenue is in range between 10 and 10.4 billion, EPS closer to low end at 46 to 48 cents, and the EBIT / gross margin weaker with ramp cost explanation. Implication, this is scale without spread, and that's the debate. Who really benefits from the AI boom? Number 3, miss on scale. Revenues below 10 billion or below consensus. After the prior revenue miss, another shortfall challenges guidance reliability and the $36 billion full year 26 target. So here's the bottom line. This quarter isn't just earnings, okay? It's credibility testing plus a margin test, because AI demand is great, but Wall Street doesn't buy servers. It's buying earnings power. And this report is all about whether SMCI is scaling and keeping enough of the upside. Anyways, I've been Max Pitts. This is Trades and Gains. This is about SMCI. Hope to see you guys in the next video, and have a great day.